Good day, Junior Techies. I'm Mrs. Brimacombe. We're going to look at Chapter 11, Financial Statements and Analysis and Interpretation, Activity 5. Now, reminder what I said in the previous activity at the end. This activity is going to focus on using financial indicators to find the figures. It's important that you understand how to do that. Then we're going to focus more also on commenting, comparing last year's figures with this year. So we're going to look at how do we look at the financial statement and interpret and analyze that. So calculate the missing figures indicated from number 1 up to number 8. So number 1, we need to find the operating expenses. Now it says there, including salaries and advertisement, and that's important because once you've calculated the figure for operating expenses, don't go and add salaries and advertisement. It says it's included in there. So in order for me to solve this, I need to know, but what was the operating expenses on sales, the percentage? Because to calculate it, it is your operating expenses divided by your sales, which is given to you, times 100 equals the percentage which is given to you. So X becomes now the operating expenses, what we need to calculate. So to find X, we need to say 28 times 2,540,000, which is your sales, divided by 100. That means my operating expenses is 711,200. So again, make sure that you know how to work backwards. Practice these things. Then number 2, I need to find the current liabilities. Now what is my options? To look at current liabilities, I can use the current ratio and the assets ratio because that goes about liquidity. It's your short-term assets, your short-term liabilities. Now there's a little bit of a problem. I don't know what is my current assets. So I can't use the current ratio. I cannot use the assets ratio because I don't know what is my trade and other receivables because you've got two options to use the assets ratio. It's your current assets minus inventories, or you can say trade and other receivables plus cash and cash equivalents. So I cannot use that. So how do I solve current liabilities? Another option, remember I said to you, BFFs, best friends forever, current ratio and assets ratio. Current ratio tells you, are we liquid? Does our short-term assets exceed our short-term liabilities? Assets ratio tells you, if we take inventory out of the equation, would we still be able to meet our short-term obligations? So if we take inventory out of the equation, they've given to you inventories, 175,000, and 1,5 minus 0,8 is equal to your inventories, which is 0,7. So I can use that to find the current liabilities by taking 175,000, which is your inventories, divided by 0,7. And that equals 250,000, which is your current liabilities. Once I've got my current liabilities, I can now solve using the current ratio to find the current assets by taking 250,000 times 1,5, which means that my current assets is 375,000. It is so important that you understand. Assets ratio means we're taking inventories out of the equation to see if we're able to meet our short-term obligations. So 1,5, which is your current ratio, minus assets ratio 0,7, because that assets ratio is your trade and other receivables plus cash and cash equivalents. So that's why we can say 1,5 minus 0,8. Now, the next thing that we need to solve is number 4, which is your trade and other receivables. This is now easy. There's easy option, and there's a more challenging way to calculate it, but it gives you the same answer. I'm going to show you both. The easy option is once you've got your current assets, you can take current assets minus inventories minus cash and cash equivalents. But you have another option. You can take your asset test ratio. If you take 250,000 times 0,8, it equals 200,000. 200,000 minus cash and cash equivalents equals exactly the same answer, which is 142,900. Right, now, to calculate number 5, our non-current liabilities, options. Gross profit? No. Operating expenses? No. Operating profit on sales? No. Net profit on sales? No. That has to do with your profitability financial indicators. It's nothing to do with your non-current liabilities. If we take current ratio and asset test ratio, it has to do with the liquidity, short-term assets, short-term liabilities. We're looking for our non-current liabilities long-term. So it's not an option. Percentage return on owner's equity? No, and it's anyways unknown. We need to solve that. Percentage return on owner's equity is net profit, which has nothing to do with non-current, and your average equity, which has nothing to do with non-current liabilities. So what is my option? The solvency ratio. Why? Because total assets divided by total liabilities equals my solvency ratio. Can I calculate the non-current assets? Yes. Oh, sorry, not the non-current. Can I calculate my total assets? Yes. That means total assets, which includes non-current plus current, divided by your total liabilities equals 2,4. That is given to you. So we can take the total assets divided by 2,4, then we find our non-current liabilities plus current. So what's our next step? Total liabilities minus current liabilities equals non-current. I'm going to repeat that in case you've missed anything. This is my total assets, which includes the non-current plus current. I need to know what's the non-current liabilities. So to find the non-current, we need to subtract the current. Next one, we need to find owner's equity. Now, what is our options? I cannot use any of these financial indicators to find the owner's equity. I do not know what's the percentage of my return on owner's equity. That first needs to be calculated. So, what is my options now if I cannot use the financial indicators? This goes back to do you understand the statement of financial position? It means actually assets equals owner's equity plus liabilities. This is an extract basically from your statement of financial position. I've got my total assets. It is my non-current plus current assets. I have just calculated my total liabilities. What is unknown is the owner's equity. So if assets equals owner's equity plus liabilities, it means owner's equity is equal to assets minus liabilities. That means we're going to take our total assets minus total liabilities to find our owner's equity. Again, applying the basics that you've learned to find figures. Number 7, we need to find the operating profit on sales, which means we need to know our operating profit, which is given to us, divided our sales, which is given. And this is a percentage, so it's always times 100. So my operating profit on sales is 21.6%. To find the last one, the percentage return on owner's equity, it is your net profit divided by your average equity, which means beginning, which was given to you, owner's equity in 2022, 850,000. The closing balance at the end of last year becomes your opening balance this year, plus you have just calculated your owner's equity for the current year, 924,000. Once we've got that, we can calculate the percentage, which is 53.5%. Right, 5.2. Should the business be satisfied with the control over operating expenses in 2023? Explain by quoting figures. So we need to look at the operating expenses on sales. Number 1, the easy part is by quoting the figures. So what happened with your operating expenses? It increased from 26% to 28%. Please listen carefully to my wording. It increased from 26 to 28%. We cannot say by 2% because the actual increase would be 2 divided by 26 times 100, which is 7.7%. You could have said by 2 basis points, but don't make it complicated. Quote the figures. It increased from 26 to 28%, and that is actually 7.7%. So take note the difference in with the commenting by just looking at the percentage by how much it increased. Because if it increased by 7.7%, that is not well controlled if you consider the current inflation rate is between 6 and 7% more or less. Currently it's 6.8%. And then we look at the fact our sales increased by 20.7%. So our turnover was much more. Our gross profit on cost of sales increased, which means that our markup percentage actually increased. Yet our operating expenses went up by so much, by 7.7%. Yes, prices do increase, but this increased by quite a bit. If we look at 5.3, during 2023, the business decided on an advertising campaign to increase the business sales and profits. Do you think this was successful? Quote financial indicators or percentages to support your answer. So let's have a look at what is happening with our advertisement. We spent more money on advertising. The business made a decision to spend more. They want to see if they can increase our sales, and this will result in increasing our profits. So we spent 8,425, which is 26.7% more on advertisement. Remember, to get the percentages, you take the difference divided before, so the 31,575 times 100. The sales increased by 435,000, which is 20.7% from 2022 to 2023. Again, take the difference divided by the smaller one times 100, or divided by the 2,105,000 times 100. The advertising spend was 1.6% on turnover in 2023 compared to 1.5% in 2022. So This means that if you take your advertisement and you divide it by the sales times 100, that is how much you spent on it. So based on these findings, the advertising campaign was successful as the sales increased by 20.7%. We increased our sales by 435,000. 5.4. One of the employees went to his trade union to complain about the salary increase he received after 2 years of not receiving any salary increases. Explain why the employee is not happy with the salary increase received, and then explain why the business would justify the salary increase. So you need to look at it from the employee's perspective and from the employer's perspective. So from the employee, if we look at salaries, the salary, to find the percentage increase, take the difference divided by 180,500 times 100, which means 4% increase. Now, he haven't received any increase in the past 2 years, and things have gone up the past 2 years. So currently, this is also below the current inflation rate. So that's why he would feel upset, because things are becoming more expensive. He can actually do less with his salary now because of inflation, of how prices has gone up. The buying power becomes less. I can buy less with the same amount of money that I've got. Or even with the 4% increase, things have gone up by so much that it doesn't even make a difference. Now, from the business perspective, explain why would the business justify by only giving them a 4% increase. So now we need to look from the business perspective. If we look at our operating expenses increased by 7.7%. The operating profit decreased by 13.6%. Or you can say the operating profit decreased from 25% to 21.6%. The net profit decreased from 23.6% to 18.7%, or by 20.8%. For that reason, he cannot provide higher percentages salary increases, as the profitability of the business went down. Question 5.5. The business adopted a fixed markup percentage on cost during 2023. Should the owner be happy with the gross profit achieved for 2023? Explain briefly. So when you see this question, you should always look at the gross profit on cost of sales. We look at, has it improved from last year to this year? And we compare it to what was the aimed markup percentage. So if I look, it improved from 68.4% to 69.3%, which is good, which is a positive thing. When compared to the aimed markup, we still have not achieved our aimed markup. And possible reasons could be we're still giving too much trade discount, example, to customers. So yes, there was an improvement from 68.4% to 69.3%, but this is still below the aimed markup of 75% on cost. If we look at 5.6, comment on the business liquidity and make recommendations where necessary. When we're looking at liquidity, we're looking at current ratio and asset test ratio. So number 1, quote the figures. Say the current ratio improved from 1.2 to 1 to 1.5 to 1 in 2023. The asset test ratio improved from 0.6 to 1 in 2022 to 0.8 to 1 in 2023. So that's the easy marks to get, is by quoting the figures. identifying the trend. Is there an improvement or not? Did it increase or did it decrease? Now the more challenging part is commenting, interpreting that. So when we're looking at this, when we look at the current ratio, the business is liquid. The short-term assets exceed the short-term liabilities. But when we take inventories out of the equation, we will not be able to meet our short-term obligations. Because now, if you look at the assets ratio, it is less than the current liabilities. It's 0.8 to 1. So there's an improvement, but we still will find it difficult to meet our short-term obligations if we are not able to sell our stock quick enough to convert it quickly into cash. So this could be that still too much money is tied up in our trading stock. So we need to be aware of that. We don't want to come to a point where we are forced to sell our trading stock for less than what we intend to, because that will now have an impact on the percentage gross profit that we achieve. So the business needs to be aware of this, that if we are not able to sell our short-term liabilities, although we are liquid, if we're not able to sell our trading stock, we will not be able to meet our short-term obligations. This concludes now this chapter, and I really hope that you have a better understanding with regards to year-end procedures when we're looking at the pre-adjustment trial balance, adjustment, post-adjustment trial balance, closing transfers, the post-closing trial transfers, post-closing trial balance, my apologies, completing your financial statements, and then the last step is analyzing and interpreting that. I want to leave you with this quote: if you change the way you look at things, the things you look at change. Have a wonderful day. Thank you very much.